All right, the White House ramping up pressure to finalize the revised North American Free Trade Agreement, known now as the USMCA. Joining us now from Washington, Yahoo Finance's Jessica Smith. So, Jess, what is the administration doing to get this deal across the finish line?
Well, lawmakers in all three countries still have to approve the deal. Vice President Pence is heading to Canada next week to meet with the Prime Minister and really rally support for the deal. Here in the U.S., the Republican Senate is pretty satisfied now that the steel and aluminum tariffs are gone. So the White House is focusing on House Democrats. The House will consider this deal first, which means that Speaker Pelosi largely controls its fate. Here's the president talking about this yesterday.
But the Democrat House is not. Pelosi does not understand the bill. She doesn't understand it. Even though unions are in favor of it, farmers, everybody just about is in favor of it.
Pelosi and top Democrats have been meeting with Ambassador Lighthizer to address their concerns. Their big concerns are environmental, labor, and pharmaceutical provisions, and then, of course, how you enforce this trade deal.
So are Democrats offering solutions to the problems they see with the trade deal? Because we keep hearing them in support, actually, of the president.
Well, Majority Leader Steny Hoyer says that they are working on specific fixes that they can present to Ambassador Lighthizer. But on the Senate side, two Democratic senators have a proposal they say will fix the enforcement problem. Senator Ron Wyden and Senator Sherrod Brown have a plan that would allow for inspections of facilities in Mexico that are suspected of having poor working conditions. And if those facilities are found to be in violation, they would no longer get tariff-free treatment. Here's why Brown says that's so important.
Raising their labor standards takes away the incentives for companies to move to Mexico, and that will help Mexican workers, it'll help American workers, and it will begin to raise living standards for everybody.
An aide to Senator Brown tells me that their plan would not require reopening the deal itself and bringing Canada and Mexico back to the table. And that's a key point because that's something the administration does not want to see. But the aide notes it would require cooperation and agreement from Mexico.
Jess, thank you. Joining us now is LPL Financial Senior Market Strategist Ryan Dietrich. And Ryan, which do you think is perhaps a better indicator of where this is all heading? Would you be looking at how investors are reacting with equities, or would you look at what's happening with the Treasury yield over in the bond market? Because China has been making some move with its holdings of U.S. Treasuries, and I'm wondering if it's because of this trade standoff.
Well, great questions there. First off, hopefully everyone has a great 3-day weekend. We'll have to talk about this for a couple of days, right? Yeah. But yes, China absolutely has been lowering some of their Treasury holdings. What's interesting, if you look under the surface, though, our good friends from Japan have actually been increasing their Treasury holdings, almost offsetting what China is doing. But that's the big question. Is the bond market right, who's saying the economy is slowing down, or the stock market, which is only 4 or 5% away from all-time highs after one of the best starts to the year? Our take at LPL Research is this. The S&P was just up the first 4 months of the year, one of the best starts we've seen in history. When you look what happens after good starts, guys, 15 times the first 4 months have been green, back to 1950. The rest of the year, so the final 8 months, have been higher 14 of those 15 times with some pretty good returns. The catch, and there's always a catch, almost a 10% correction on average intra-year. So yes, we're talking about trade, we're talking about the global slowdown. Our take is there's probably time for a correction, and we've been saying this for a while at LPL Research after that good rally. We think it's just a normal correction. Maybe we can go down to about a 10% correction on stocks. It'll feel weird. It'll feel uncomfortable. But after a 25% bounce from the lows, we're thinking it's more of an opportunity and we can have a second half acceleration in the economy, global economy.
I want to ask about that second half acceleration in the economy because JP Morgan, the team of economists there, just out today and cut their forecast for second quarter growth, not second half growth, but second quarter growth. They're now looking for just 1%. They had been looking for 2.25%. So, I mean, in other words, what kind of sort of suppositions is your forecast based on in terms of the underlying economy?
Sure. Well, we had a pretty good first quarter, let's not forget. Now we're definitely most of that economic data. The manufacturing data we just had obviously was rather poor. We do still think at LPL Research, it comes down to productivity, right? We had a really good first quarter print on productivity. If productivity can continue to increase, that can extend this nearly 10-year-old economic cycle. The key, obviously, to everything, guys, is the U.S.-China trade deal, right? Can they get some type of a resolution, or at least a path to resolution? And we're still of the opinion that before probably the end of the summer, we can have that, and that can increase the global economy. But at the same time, we've been talking about the trade stuff for a while now, right? Almost over a year now. The bottom line is the economy's held in there. Earnings continue to come in better than expected. Yes, it's a slowdown. We're aware of that, but we just don't see signs of a recession. And that's when you have the worst market corrections and obviously the big problems happen. We just don't see a recession happening in the second half of this year. And with their trade resolution, that can increase confidence.
Hey,
and we really do think a stronger economy coming in the second half of the year.
Hey, Brian Chung here. So I want to bring the Fed into this, and I'm curious about your thoughts in terms of what the impact of the existing tariffs or perhaps the looming threat of an additional $300 billion of tariffs on Chinese goods would do to the inflation picture and what that might do for the Fed, especially given the fact that they've said that the issues that we've seen so far are transitory, but that if it continues to undershoot, maybe we need to cut rates.
Right. We're of the opinion we're not going to see a rate cut this year. We see 3% GDP growth with relatively low inflation, like you said. We just don't think that's the camp. I'm fully aware of what Fed Fund futures are saying. They think there's going to be a cut. At LPO Research, we think they're just going to kind of stand pat the rest of this year. But you talk about what's the Fed saying? The Fed is on record as saying they're not even sure why inflation's not higher right now, right? A lot of economists have been talking about that for years, why inflation's not higher. I think it's probably got something to do with, cell phones. You can look on your cell phone, get the best deal. That's kind of globalization is really keeping inflation low. So our stance, again, of the Fed is on pause. You look back at history. We saw the Fed do this before in the mid-90s, 94, 95, increase rates, and they went on the pause and had a surprise cut, actually, July 95. The economy was better in 94 than it was in 95, yet stock market did better in 95. We see some similarities. The economy was great last year. Stocks had their first losing year in 9 years. Now the economy is slowing, but the Fed is still accommodative. Fiscal policy is still accommodative, and those are those reasons we think, yes, we could have a correction in stocks, but we still think this bull market's alive and well. We have a 3,000 target on the S&P this year, and we've held that all year. We didn't cut it earlier this year, and a lot of other people cut their targets. We still think it's quite logical. That's where the S&P will end up. It's going to be rocky, but we can get there.
Ryan, 3,000 is a magic number today, not just because it's your target on the S&P, but there's that story about Amazon. We've got to let it go there. But Ryan Dietrich is the LPL Financial Senior Market Strategist, and always welcome here at On the Move. Thank you.